A Fed pivot is to be expected in 2023, according to today's guest, Mike Singleton. Mike is Senior Analyst at Invictus Research and joins us for the first time here on GoldCore TV. In his chat with our host, Dave Russell, Mike gives us his thoughts on inflation, the US dollar, and what the future holds for gold and silver prices. You'll hear what market indicator Mike thinks is key for us to look out for to understand when the Fed will pivot. And you'll also hear Mike's explanation of what indicator gold and silver watchers should be on the lookout for. This is a nice short interview, but we pack a lot in. And by the end of it, you'll be looking for another excuse to extend your coffee break. So if you have any thoughts or comments, then why not take the time to put them in the comments below and subscribe to GoldCore TV whilst you're at it. But for now, I leave you with an interview between Mike Singleton and Dave Russell.
Mike Singleton, welcome to GoldCore TV.
Thanks for having me, Dave. Happy to be here.
Great to have you. Now, I want to start with a question. We've got the Fed fairly much caught between a rock and a hard place at the moment. We've got record levels of inflation, and they have a choice now, which is to continue to attempt to get this inflation animal under control by raising rates. But what they may risk doing that stage is totally killing the economy. What are they going to do?
So our view at Invictus is that they're probably going to totally kill the economy. Like you said, the Fed is between a rock and a hard place. Inflation is very, very high. Their communications to the market and to market participants has essentially been that they're not going to pivot until they see signs that inflation is going back down to target. Our view is that really can only happen if the employment market, if the labor market gives out. And we know that's pretty much how every policy cycle has ended since as far back as we have data, or 11 of the last 12, something like that. And there's no reason to think that it won't happen again. So that's kind of the next shoe to drop in the business cycle, so to speak. At least that's what we think.
Okay, and then as a result of that, so you think that we've got what, maybe another couple of hikes in it, or are we going to be hiking into 2023 at this stage?
Our view is that the labor market will begin to show cracks between February and May.
Right. And
so that's when you would, I say show cracks, that's when you'll start to see a nonlinear increase in the unemployment rate. So that's when we would expect to see a pivot. That's when we would expect to see rate cuts. And we think that the Fed will try and hike right up until then.
Okay. So potential for rate cuts now into 2023. Going to hike until then and then start cutting because they're going to have to pivot, you think, driven primarily by labor market issues. Do we still have an inflation problem at that stage?
No, so inflation, we're sort of the school of Milton Friedman. It's always and everywhere a monetary phenomenon, but it's also always and everywhere a phenomenon of supply and demand, right? Supply and demand for goods and services. And the reason that we saw such high inflation is that through the COVID lockdowns, no one was working. So there was numerous supply constraints in terms of producing goods and also services, but mostly goods. And there was a bunch of money printing. So you saw consumption go way up as a result of money printing while output went down, and policy like this tends to happen on a lag. So it took a little bit of while, but we ended up seeing the highest inflation in 40 years. So the way that the Fed would in turn try and bring down the inflation is by reducing demand. I think everyone knows that the Fed can't do anything about the supply side of the economy. They can't, for example, drill new oil wells. And so the way that they reduce demand is through interest rate policy and eventually increasing the unemployment rate. If no one has jobs, then consumption is probably going to go down. That makes sense logically. That's historically what the data tells us. And so we think that'll bring inflation back down. That'll bring inflation back down really, really quickly. And I think that there are a lot of inflationistas that don't really see how that could happen, but it's happened numerous times in the last 40 years. It happened even in the 70s. When demand goes down, all else even, inflation will go down as well. Now, there's still the longer term inflation question, right? Will we see a decade of inflation where sort of the stationary mean of inflation over the next 10 years is higher? I think that's a different question. But cyclically, I think the odds of slower inflation are very, very high, meaning over the next year or so.
Okay. There are some that talk about a potential for a deflationary era quite quick or quicker than we would be expecting. Do you think that that's a possibility, or do you think that we might still see inflation in the areas of energy and food that are going to keep the inflation rate relatively high?
No, I think we think it's coming down, right? So back to the Milton Friedman framework for understanding inflation, it's always and everywhere a monetary phenomenon insofar as growth in new money is outpacing output, right? And so what have we seen? We've seen growth in new money come down pretty aggressively over the last few months. That'll take time to flow through the numbers, but it's happening. And when you look at the output side, supply constraints are resolving very quickly. I mean, you can see it in the various regional Federal Reserve data. You can see it in the New York Fed's Global Supply Chain Pressure Index. Supply chain pressures are pretty much, they're easing in the United States and they're easing globally, believe it or not. And so that should bring down inflation. In terms of energy, I think energy is the biggest risk to long-term disinflation because we're not really seeing any increased investment in energy. But in the short term, slower economic demand broadly will reduce the price of energy commodities, even if no new supply is brought online in the next 12 months.
What's
and
the
reason for that?
Sorry, continue.
And just the reason for that is because energy is used in everything. Crude oil and its derivatives are used in everything. They're used in everything from the Tupperware on your shelf to cosmetics and lotions and lipsticks and asphalt and roofing material and other construction materials. And so when all that stuff slows, the price of oil tends to go down. That's our expectation. So over the next 12 months, we really can't be bullish on energy commodities. On the longer term inflation issue, we're sort of inclined toward being secular disinflationists, but energy is a big hole in that thesis, right? And
Indeed,
there's no evidence that it's been solved yet.
Right. And given your inflation outlook and your timing of a Fed pivot, what does this actually mean for real rates?
We think real rates probably go higher until, call it, February or March. Maybe they top out around I'm looking at the 10-year real rate here, between 2% and 2.25%. But then when the Fed cuts, real rates will come down. Really, real rates are driven by just two things, real growth expectations and policy expectations. But when the Fed is going through a really aggressive hiking cycle, really policy expectations are what's driving most of the movement there. So as long as the Fed is hiking, real rates will go up. And then real rates will pause and come down when the Fed stops hiking and in turn sort of pivots.
And what about the implications for the stock market now, between now and 2023, before they pivot and then post-pivot?
I have a very hard time seeing any kind of bull case for the stock market. There are really two reasons that the stock market moves up and down. One is real rates and one is earnings expectations. A lot of the damage that we've seen done to the stock market so far has been a result of increasing real rates, increasing discount rates, reducing multiples, so to speak. And the earnings recession hasn't really been priced in yet. And in our view, that's kind of the next shoe to drop. We don't think that the Fed will pivot. We don't think that the Fed will stop raising real rates until there's ample evidence of an earnings recession. So any breather or bear market rally that we see in stocks, we expect will be short-lived.
Right. And in terms of precious metals, obviously our audience is very keen to hear what you have to say about gold and silver. How does this play out for gold and silver, given what you're suggesting for real interest rates?
Well, that's a good question. And like you just suggested, if you really want to know about what's going to happen for the price of gold and silver, and particularly gold, you really have to understand real rates. It's one of the closest relationships in financial markets. It's, a 92% correlation over the last 30 years or something like that. There's very, very few relationships in financial markets that are that close. So again, what drives real rates and in turn the price of gold? It's growth expectations and it's policy conditions, right? So when does gold do really well? It does really well when growth is slowing and policy conditions are easing. So for gold to do growth is already slowing and we expect it to continue slowing for the next 12 months at least. So gold already has that going for it. Gold's actually outperformed pretty much every other risk asset, so to speak, this year. Really for gold to outperform further than that and to start to have really positive returns, we would need to see a pivot from the Fed. We don't think that's yet. We think that'll happen, like we said, between February and May. But that's kind of the necessary condition we need to see for gold to sort of have its next leg up as a bull market.
And in terms of the US dollar, I mean, one of the themes of 2022 has been US dollar strength. And US dollar has performed well about basically against every currency. The dollar index is up over 112 at the moment, have been only marginally higher than that. How does this play out for the dollar with, again, with the Fed continuing to hike into 2023, as you expect? You would probably suspect also that we're going to see an even stronger dollar. There's two questions there. At what stage does that become a real problem for the US? and then post pivot, given the expectation for a cut into 2023 or the second half of 2023, depending upon how aggressive they are, do we start to see a reversal of that strong dollar?
It's a great question. The dollar really trades on two things. One is rate differentials, which is kind of classic carry trade dynamics that you would read about in textbooks. And two is risk appetite, which is a little bit harder to quantify, right? But like you said, we expect interest, rising real rates and even rising nominal rates to be a tailwind for the dollar going into the first half of 2023. When the Fed cuts, will we continue to see dollar strength? Well, it depends on what's going on in the rest of the world. Our outlook for the global economy is pretty bearish. And until the Fed eases, I'm going to say somewhat aggressively, there's going to be a dollar shortage, so to speak. It will hit emerging markets particularly hard. And you'll start to see that sort of dollar feedback loop, that dollar doom loop, until the Fed eases and provides swap lines, or in other words, gives other economies the tools that they need to service their dollar-denominated debt to sort of break the deflationary debt service doom loop that happens when there's a really strong dollar.
At what level do you think that actually becomes a problem for the US? It's already obviously becoming a problem for a lot of economies around the world, but at a certain stage, it's got to start to become a problem for the US itself.
I don't really think of it as much as a problem for the US, except that it's a global deflationary force. And so it'll amplify some of the negative economic phenomena that we're experiencing in the US through a recession. But the dollar going up in and of itself, I don't think is that bad for the US economy. I mean, actually, if you look at the Dixie Dollar Index versus the S&P 500 since 2009, there's been a positive correlation between the performance of stocks and the dollar, which a lot of people don't appreciate. You probably need to cut up that data a little bit to look at how the dollar performs during different growth, inflation, policy regimes. But the fact that they're positively correlated over such a long period of time tells you that strong dollar doesn't necessarily mean problems for the US.
Okay, so it's really this labor market statistics that we need to be keeping a close eye on to give us a hint of when the Fed will pivot. And you see them potentially aggressively lowering rates?
I don't think it'll be aggressive at first. I think the Fed is going to be very wary of being too aggressive. I think the fiscal response will be extremely cautious. Why? Because the last time through COVID, they took out the big guns, and maybe that was necessary at the time, but clearly the consequences have been rather dire. It's been, just look at consumer sentiment, look at real wage growth. It's even hard for the upper class because they own a lot of financial assets, which has done poorly. I mean, the last 6 months, basically since the beginning of 2022, the economy has hit everyone pretty hard. So I think that the Fed and the federal government will have to see persuasive evidence, very persuasive evidence that things are going really wrong before they step in as they would in a typical recession.
Well, with national debt now standing at $31 trillion, continuing to hike rates also is going to start to bite them in the backside some stage soon, isn't it?
Right, that's true. I think a lot of people, for some reason, I've heard a lot of people talk about, well, the national debt is so high, maybe traditional interest rate policy doesn't work. In our view, that actually makes traditional interest rate policy even more potent. The more debt there is, the more onerous it is when interest rates go up. The more onerous it is when you have to recapitalize or refinance at higher levels of interest. Then that goes for public debt, that goes for private debt. Generally, public debt is a little bit less explosive than private debt because the government has various levers they can pull to sort of mitigate the effects, such as central banks buying bonds. But in any case, yeah, higher debt is generally bad for, it makes policy cycles even more painful, and it's bad for forward growth in any situation. So the debt is definitely something that, everyone should watch out for.
Now, before we wrap up here, can you tell us a little bit more about what it is that Invictus does?
Sure. Invictus Research is it's a provider of hedge fund quality research for basically anyone who wants it. We provide all sorts of research products. We provide a daily, a weekly, and a monthly. The daily product is sort of our most popular. It's our flagship product. It's sort of a 5 to 10 minute overview of the prior day's major economic data releases, puts them in the context of the business cycle, talks about how to position around that, and it starts at just a couple dollars a day. So it's hedge fund quality research for everyone.
And where can our subscribers find out more about that?
Invictus-research.com, and they can also follow me on Twitter at Invictus Macro.
Super. Well, what I'm going to do is I'm going to stick a link to your website and also your Twitter handle in the description and show notes below this video. But until next time, Mike Singleton, thanks for joining us on GoldCore TV.
Thanks for having me, Dave.
Our thanks to Mike for joining us on GoldCore TV. We'd love to know your thoughts on his and Dave's conversation. Do you think we can expect a Fed pivot? If so, when? Or what about US dollar strength? Is it unstoppable? And don't forget to check out the rest of GoldCore TV. If today's show has made you want to delve deeper into what is going on with the economy and precious metals, then we have countless interviews and commentary pieces from industry experts and our very own team here at GoldCore, all of which will provide some food for thought when considering your own investments. And speaking of which, if you are thinking about adding maybe some gold or silver, or maybe even both, to your portfolio, then head to goldcore.com. We have a range of bars and coins available, and there's something to suit all types of investors. We have a brilliant team on hand who are happy to answer any questions you may have. So head to goldcore.com, your precious metals experts, and we'll see you next time.